In the last week, we have seen volatility happening in the bond market, not only in the US Treasuries market, but also the global bond market, because as I mentioned, the global bond market is the bedrock of the financial system. And we have seen a lot of volatility happening in that market since the Federal Reserve announced that the rates are going to stay higher for longer, kind of a narrative. And a lot of other central bankers like Tiff Magnum from Bank of Canada also kind of supported that argument, saying that the inflation is not under control yet and the rates should or could stay higher for longer. And since then, we have seen enormous volatility in the bond market, primarily because the investors, the financial institutions, the banks who carry that government debt on their balance sheet, they started selling it, especially the long-term debt, 10 years or 20 years or 30 years, because they know that they can get higher return on keeping the money in the short term of the debt versus keeping it for long term, which is pushing the long-term yields higher. So when you see this is happening, and if it continues to happen in the long run, this is creating a perception that the rates are going to stay higher for at least near future. That will push up a lot of interest rate requirement on the consumer debt market. For example, mortgage. So mortgage rate is a prime example. When you see the bond market pushing the yields higher, at least in the near future, we can expect the mortgage rates, especially on the fixed mortgage side, will continue to go up and stay up for a long time. So everywhere, like in the US, Canada or UK, we will see the fixed mortgage rates are going to go up and stay up for quite some time. So this is creating a lot of stress in the housing market already. And then when we look at how this is happening, so basically when we look at the bank's balance sheet, so banks have a lot of these debts on their balance sheets. When we see the yields going up and the market is selling off these long-term treasuries, these commercial banks who have these bonds on their balance sheet are seeing a big hole, massive hole, in terms of the unrealized losses on their balance sheet. So if they are forced to liquidate those assets, we can see a repetition of what we saw in the March, like SVB and First Republic. Those banks, they were in the same position, so they were forced to liquidate their bond portfolio, and they were basically seeing the unrealized losses. And when they did that, it actually created a self-fulfilling prophecy when the bond market is going through a sell-off and reducing the price of the bond. So we can see continue to happen like this if things continue to stay like that and gets deteriorated over time. Now, somebody asked me, okay, what does it mean for Canada, or let's say Canadian banks? I think Canadian banks will be in the same position. We just don't have enough data to look into the Canadian bank's balance sheet, that how much unrealized losses they are carrying as a result of keeping the long-term debt on their balance sheet. They must be keeping some US Treasuries and Canadian Treasuries, and all of these long-term Treasuries are going through a sell-off, which means that if they sell that bond, that asset, before its maturity, they will actually carry a loss, a big loss, to be honest. Because if you look at the TLT position, it has gone like 50% in this calendar year already. So since that higher for longer narrative came out, all the major bond market yields spiked up. US, UK, Canada, Germany, which shows the market is expecting higher rates, at least in the near future. Now, what is the impact in the other segments? So insurance companies, pension funds, they carry a lot of these treasuries on their balance sheet, and since that narrative came out, which is higher for longer, we are seeing a sell-off also happening in the insurance stock market. So all of these major insurance companies like Generali, Allianz, AIG, Prudential, they're all going through a stock sell-off in the market. Similarly, pension funds. So pension funds, a double-edged sword for them, because when they see the yield on the government debt is rising, they also get benefit out of it, because they can then buy cheaper assets to make profit off of it, because now they're getting more return on their assets purchase. But at the same time, if the yields go up aggressively in a very short time, we can see a repetition of what we saw in the UK gilt market last year, where some of those pension funds were forced to sell those bonds because they were getting margin calls to cover up the shortage of the collateral on the balance sheet when UK gilt market was collapsing. So it could happen. So if it's a matter of how quickly bond yields go up and in short time. So what happened in the last week, if it continues for next 2, 3, 4 weeks and it gets deteriorated or gets aggressive, then we could potentially see a sell-off in the bond market, especially from the pension funds to liquidate those assets to look for more collateral. All of these signs are basically creating a potential black swan event. I think about what could possibly go wrong in the financial system today. I think what we should be afraid of, or we should be worried about, is the black swan type of event. And when we see these things which are playing out in front of us in terms of aggressive high bond yields in a very short time, it could potentially break the pension market, the insurance companies, and the commercial banks, because commercial banks have a lot of debt on their balance sheet, which is basically producing unrealized losses. Right now, they're not forced to sell. A potential bank run like SVB or First Republic in the US, it could trigger a sell-off in the market from those balance sheets, and then they could trigger a major loss by liquidating those bonds before the maturity, because they are 50% down on their value. So this could potentially be a black swan event, to be honest. And as we further see these signs coming out, and the yield curve inversion is a perfect example of that. So when you see the yield curve has been predicting recession or kind of a economic crisis over a century, it could not go wrong this time as well. So all of these things are kind of pointing towards something that we should be prepared for, because things are not really looking good, and we all should be ready for facing this kind of an event. So anyway, this is just my finding, my observation, my thoughts. Let me know what you think. Put your comments down below. If you like this video, give me a thumbs up, subscribe, and I'll see you in my next video. Thank you.